Hello everyone and welcome to this section of the course. So in this lesson, I'm going to go through the whole swing trading system that we use here at the Two Traders. And this is a Bollinger Band with filter system that we've used and back tested for several years now. So let's get into it. So there's 4 different parts to a trading system. The setup in terms of indicators and analysis patterns that you use, um, your strategy for entering trades, your stop loss placement, and then your exit strategy. So let's talk about how the swing trading system works. And I'm going to show you some examples of trades using the system as a way of explaining how it works. So first off, here you can see Euro Swiss franc. Now, this one, you've got a Bollinger Band. So you can see here the Bollinger Band system with the red line in the middle for the moving average on the Bollinger Band, 2 standard deviations width, and 45 days. So we're on the daily time frame, 45 days period. Then we have a moving average, simple moving average, and that's a 60-day one. And you should understand how this works in terms of filters if you've already watched and learnt the lesson from Bollinger Bands and filters. So essentially what we're going to do is we're going to look to sell the market when the Bollinger Band shorter moving average is below the longer simple moving average, and we're going to look to buy when the opposite is true. However, the key point is we're not going to buy and sell any time, which you can do, but is not as very effective. We're only going to do it when there's abnormal price movements. So that means when you've got a breakout from the Bollinger Bands or when it's breaking in to the Bollinger Bands. I'll show you the examples in a second. The other key thing is the average true range, but we'll come on to that for the stop loss placement. So let's see what happens here. So you can see there's a consolidation period in Euro Swiss franc. This is October, November, December 2019. So if I play a few candles here, you can see it's still within the Bollinger Bands, and then suddenly here it drops out. Initially, our moving averages are looking for buys, but in the next couple of candles, what you see happens, moving averages cross, and they've crossed here on this candle. And that's important because this candle also closes outside of the Bollinger Band. And we're always looking at the close price on the swing trading system because it's at the end of the trading day. That's the most significant price point. And that's when we look at the charts and we put in our orders for the next trading day. So it's always the close price. Now, if you look at the numbers, you can see on the top left of the chart, the Bollinger Band has a lowest value at 1.08738, and this candle here closed at 1.08684, and that is below the Bollinger Band, like I said. And the moving averages, you can see the red and the blue numbers in the top left, 1.09644 for the Bollinger Band, 1.09653 for the moving average. So you can see that the moving averages are the correct way around for a sell. And the momentum is going that way as well, which is useful to know. So how do we actually enter the trade? So that's where we move on to the broker chart. So using this candle here and looking at the 24th of December, where are we? Here. So let me zoom in a bit. Right. So 24th of December. There we go. Okay. You can see the candles look slightly different. That's because the broker timings are slightly different to the ones on the TradingView chart. So the candles will be a bit different. But what I do is I use TradingView for the analysis. Then when I go to place a trade, I'll come over to the broker charts for things like the spread and the average true range, because that's where I'm actually placing the trade on the broker. This is the XStation platform, which you probably will be familiar with now if you've been working alongside the course on a demo account. So yeah. Now what I'm going to do now is take you through how I'd actually place a sell order here. So the first thing we need to know is the close and the low price. So I've got a handy little spreadsheet which will do calculations for me. This is similar to the trade tracker you might have seen at the start of the course, but this one's more customized to this swing trading system. You can develop your own for your own system, but this is the one that I use. So first of all, we can go nearly here, just to be clear. Date, I'm going to leave that for now because this is for determining when to close the trade. So I'll explain that in a minute. So this is a sell position. What's my ATR? So we go to this day. You see the yellow line at the bottom is the ATR, 20 days. And in the top left, you can see the pop-up box says it's 0.00387. The close price, you can see in that box as well, 1.0861. And the low price is 1.08568. So we put those values in. The spread, we've got some usual values there already, but I'll just double check. Actually, I can't see the spread on this particular day. I can only see the current spread. So I'll just leave that for now. But what you should do when you place a trade is update the spread, because you account for the spread in your stop loss. So you can see it's automatically calculated my order price and my stop loss. You'll notice the order price is actually the same as the low price. So that is because the order is simply order plus spread. And when you're doing a sell position, you're actually already accounting for the spread there, because the price you see on the chart is displayed as that sell price. Whereas if I put this as a buy and it was a high here, you would have to add the spread on. So you can see in my formula here, actually, if buy, then add the spread. If sell, then just the number in this box here. And that's how that order works. Okay, so it's got 1.08568 and our stop loss is 1.091. Now what this is doing is 1.2 times the average true range. So it's a multiple of the average true range. This is a method for placing the stop loss. You can customize this number. It doesn't have to be 1.2. And in fact, we used to use 1.4, but we adjusted it to account for a slightly more volatile market. Basically, we decided that a slightly tighter stop loss was better given the market conditions at the time. But if you want, you can play around with this and choose your own values. Anything between 1 and 2 seems to work fairly well. We've gone for 1.2. So what this does is multiplies ATR times 1.2, and then adds or subtracts that from the close price if it's a buy or sell. So that gives us a stop loss at 1.091. So let's go and place that trade. So we'll have to do a sell limit because we're not actually on that date. At the price, 1.08568, 1.08568. We'll leave the volume for now because we do the stop loss first, as I would have explained in the position sizing and introduction to risk management lessons. So go back to those if you don't remember how to adjust the percentage risk and and the volume. And our stop loss was 1.091. And what you can see here is that the percentage risk is 2.3. So because I want 2% risk, I'm just going to reduce this slightly. Uh, 47, 46. So 0.44, that will do. And if I just put that on the chart, you'll be able to see the levels. So you can see there, so the stop loss is up here, the sell is there. Now, actually what you see is on the next couple of days, the price came back up. And this is reasonably common with swing trading. You will see some losses, particularly at the start of a trade. It's simply the way that the market works. Like usually, if it breaks out, it might come back in and correct, and then continue down. That's very common to see, but it's a test of your nerve, really. With the swing trading system, it's designed so that you actually can place a trade like I've just done and just simply leave it until your exit strategy triggers. And either your exit is going to be your stop loss or a time-based exit or a moving average crossover. And I'll come on to that in a second. But you can see the orders at 1.08568 and then the stop loss at 1091. And if you see the next candle, the lowest point on that one was 1.08602. So actually, I think our order wouldn't have been quite taken on the next day. The order would have been taken on this day instead. But even if it was just about taken on the 25th, our stop loss wouldn't have quite been hit. You can see these highs didn't quite reach. So we're in the trade now. And all you have to do is let the trade run. Now, what this part is for, this date, is for calculating the time-based exit. If I were to put in the 25th of December, 25th, then you can see the days is 194. And you need the day of the week. I can't remember what day it was. Let's just go with Friday. You see, it tells me I need to close the trade because it's well over the time-based exit. So you can see in this formula here, it's based on the day of the week. Essentially, all this is trying to do is 14 trading days, so 2 full weeks of trading days. After that time, you want to close the trade. So if we count on the chart, actually, we can scroll across. So you can see we got in on this day, so that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So you can see actually we'd be closing on the 13th of January here. Now, what this tells you is close the trade. You don't have to strictly follow that. You can if you want to strictly follow the rules, but if you feel like you're comfortable with having sort of slightly flexible rules, what you can do instead is move your stop loss to lock in some profit. If you see that the market's in a favorable position and might continue to move in the same trend, so I could move my stop loss to break even, or a bit further down if I wanted to a previous high. That's what I usually tend to do. But doing that, you do need to have some sort of knowledge of levels of support and resistance, and use that to base your new stop loss. So if I'd done that, you can see I wouldn't get stopped out in this case, but sometimes you might get stopped out prematurely if you do. So there's always that balance. But in this case, you can see the market continues down, and we could stay in this trade all the way down to around about here, where you see there's a correction and we're no longer sort of trending down. It's flattened out and come back up a bit. And the other thing is it's hit this moving average. That's usually a sign of a reversal to the Bollinger breakout trend. When it comes back to the average again, that's a good sign of closing out the trade. So I'd probably have closed it here. And if I just show you what that risk to reward might have been, we'll go forward on here, see how it played out. So you can see it fell. This is all good profit. And then, yeah, that's where we'd get out roughly. And if I just add this short position here, and I think we got in at 1.0861, and our stop loss 1.09, what was it? 1.091. And then bring this down to around about the close of those candles. So 3.6 risk to reward there. That's not bad. That's a pretty good trade. So for swing trades, you're always looking for a decent risk to reward, 1-to-1 or better, especially on the daily time frame, because you're looking for those abnormal price movements. You're looking for big moves, big money moves. Those are the ones that you want to capture, not little tiny moves during the day. Like you don't want lots of trades like this, because you end up going to lose money. The swing trading, you're going to lose quite a lot of trades, but each trade you lose is only 2%, and then you get one trade like this, and that's equivalent to making up the losses of 3.5 trades in one go. So you can see how this could be quite profitable with the right sort of risk management and the right markets. So that's how you place a trade. I will show you quickly a different version as well on soybeans. So this is soybeans back in November, December 2019. You can see our moving averages here again. And in this case, we're looking for buys because the shorter Bollinger moving average is above the longer moving average. So we're looking for buy positions. We broke out the bottom. We didn't enter here because we're looking for buys. And then what happens is it breaks back inside the Bollinger Band. This is a sign for us to enter on a mean reversion trade. Now you see I've circled here, there's a wick at the bottom. This is a little trick with price action. If you see two big wicks in a row, that's a good sign that the price doesn't want to be down at that level. People are buying. There's some buying pressure down there. This is covered more in the price action sections of the course, but it's important to know that you can apply it here as well. Then you see this candle. This is where we broke into the chart, into the Bollinger Band, and you got that the right way. So now again, I would go over to the broker chart on soybean. Look, here we go. Here's the setup. We've broken back inside. Our close is at 877.48. And then what we can do is go on here and we can place the trade. So we can go buy, and our ATR was 10.01, and our close 877.48, and our high was 879.52. Let me just put that in. Our spread, I'm not sure what it was, but got one in here, which looks about right given the current spread. So you can see the spread from up here, the difference, or if you actually search in the box here, it will tell you the current spread. So right now it's 1.24 pips. That's current time, not back in December, but we'll leave it as at that for this illustration. So we've put the numbers in, so you can see our order and our stop loss automatically calculated for us. 880.52 and 865.5. And let me put that on the chart just to show you. 880.52. Stop loss by 865.5. And then you change your spread. You change your volume. So you want 2%. So 0.05 or 0.06. I'll go below 2 for less risk. Put that on there. So that should be about right. Yeah. 865.5 stop loss, 880.5. That matches with what it says here on my spreadsheet. So that's where you place at the top of this candle here. You can see the order is up at the top there. That's based on the high price. Yeah, high price plus the spread. Okay, now let's see how this one plays out. So market comes up, order gets taken immediately on the next day. And then you can see it actually gapped open here. You can see the price jumped up to here and went all the way down back to there, came up again. And as we go along, you see it roughly hits near the top. Important note here is that during a swing trade, you will see times where your profit reduces, and you need to have resilience to just let the trade run until your exit strategy says to close. Now, the interesting one about this one is if I go back to Trading View and just play this chart out, you'll see what happens, and you see that circle there. The moving averages cross here. Now, that's the other sign of getting out. So we've only had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 trading days at that point. So our time-based exit hasn't been triggered, but moving average cross has. So you might choose to close the trade out here, and I probably would have closed the trade. You could also move the stop loss up, potentially to around the moving average area, might be a decent option. And if you had done that, you might be able to get a little bit more profit closing it up here instead of down there. But you never know where the top is, and that's a really important point. You can't call the top on a trade. That's why these time-based exits and moving average crossovers are so good, because it tells you when to close the trade. It's not up to you to use your judgment, because more often than not, you're probably going to get it wrong. And that is how you do the trading with our swing trading system. Okay, so I think I've covered that everything there. So the setup, you've got a Bollinger Band, 45 period on the daily time frame, 2 standard deviations. You've got a simple moving average, 60, and then the average true range to enter the trade, to place your stop loss. I use 1.2, but you don't have to, and you can use your own strategy as well, of course. And the 45 and the 60 is also a personal choice. We've back tested a couple of different options, and they all have quite similar results. So you can use anything between about 40 to 60 on the Bollinger Band and 50 to 80 on the moving average, and you'd get fairly similar results overall on historical trades. So yeah, don't use what I've got here as gospel. You can change things, and you can also design your own swing trading strategy that's completely different to this. I'm just showing you what I've been using, and it might give you some ideas. And then, yeah, remember the exit strategy is based on a time-based exit, so 14 trading days, or the moving average crossover. And that's it. So that's your Bollinger Band with filters, swing trading system. And remember, you can create and customize your own trading system to suit your own style of trading. This system allows you to trade very quickly and look at the markets for 30 minutes, and you already know what trades you're going to take. And you can do that once per day because it's on a daily time frame. Day trading means you have to be a bit more involved in the charts. If you're trading an hourly time frame, you'll have to check it throughout the day, and it requires more time, but maybe there's more reward there. It's just purely up to you and what works for you. So that concludes this lesson. Hope you enjoyed, and see you in the next one. Cheers.